Hey everybody, this is Jose Blasco. We are about to get started in just a few seconds. As a sound check, please go ahead and type a quick message on the chat box. A quick hello would do. Nice way to start the session, and also that would tell me that you hear me. So please go ahead and do that. And we're starting in 25 seconds. Thank you so much. Very good. 10 seconds to go. Thank you for that, Joe. How are you, everybody? Very nice to see you. Christian, very good. Perfect. So we just reached the top of the hour. Very good, Jeff. Good to see you as well. Everyone, welcome to the session. Today it's April 21st, 2022. This is Options with Options. This is the place where we look at the markets live and we trade options. My name is Jose Blasco and ready to begin and excited for the session today. Before we get started, as always, I'd like to highlight our disclaimer on the upper left side of the screen. Please read it carefully. As always, we are counting on you to read it carefully, completely. It is important information, and therefore I'm counting on you to not to skip it at all and read it completely, as I said. Thank you so much for that. With that said, the agenda for today, as always, we're going to be looking at the market, understand what's happening out there. Interesting day for us to meet, actually, because there's been a clear change of market condition today. So we're going to comment on that. How are you, Mark? Good to see you. And from there, we'll move into trade management. We'll review the trades that we have. We'll talk about what we need to do on those trades and then move into trade execution. So that's the plan. Let's begin. Very good. And thank you again for all your confirmations on the chat box and everything else. Perfect. Okay, well, here's the S&P. The S&P 500 index, daily time frame of the S&P. A moment ago, I said that we had a clear change of market condition, and we can see it here with moving from a thin dot the day before to a thick dot today. We have a confirmed market condition. The color of the dot is blue, so it's an up market condition, which is nicely reconfirmed with an implied volatility for the calls in blue color to be greater than the implied volatility for the puts in gray color. So with those two things together, and the fact that the current count is 2, where statistics suggest an up climate on the S&P on a daily time frame is statistically going to last for 6 candles on the way up. So all of this tells us it's a perfect day to start looking for options opportunities where we are bullish and directional. It was a long time I didn't make such a statement in a such clear and simplistic manner. We've had many weeks, and of course the world is crazy indeed with the war and everything else. We had a lot of indecision in the marketplace, climates that broke, climates that lasted more than expected. Lots of dots here with unconfirmed climate changing from blue to red. We've seen a lot of that, and it was difficult for the market to define itself. But today we do seem to have a confirmed and reconfirmed market condition, both with the market data from the charts as well as the options data coming from the implied volatility from the calls and the puts. Okay, my screen is not looking good like the last time. Back okay now, messed up again. Interesting. Let me, not sure why would that be, but let me go ahead and stop sharing screen and restart sharing. Hopefully this will fix it. As I restart sharing, Mark, if you could confirm that all is good, that would be great. Ahmed, how are you, my friend? I'm just noticing your message as well. Good to have you with us in the session. Thanks for your support, by the way, on those chats that were taking place in that WhatsApp group. Thanks for that. No, not everybody understands. Which is in a way normal, in a way sad. But yeah, thank you for trying to help that community. That's very nice of you. All good now. Perfect. Thank you so much. Not sure what happened, guys. But anyway, so going back to the analysis of the market. So we have all of this confirmed. We also had an Elliott wave turning point that was identified 2 candles ago, with price moving higher obviously that LOA turning point becomes more relevant. And we also need to keep in mind that this blue area, this blue shaded area above, is supposed to be the end of the wave. Okay, so we need to keep that in mind. Again, I'm not saying that this is a problem. It's perfect. We are pretty low in that wave, plenty of room to go. Climate begins, options that are confirming all of this. So really, today we're gonna get directional, looking for opportunities to be bullish. Okay, catch moves to the upside. Yes, I saw that, Ahmed. Then after doing that, they mentioned that they will re-add you in 24 hours. But yeah, that was a funny move, really. That made no sense at all. Sorry about that, my friend. Christian, on SPY, big red UFOs right above. Not a concern, not a concern. And the reason why, Christian, is because remember the concept is in an up climate, the sell on field orders tend to be cancelled, the buy on field orders tend to be added. So, in that sense, I mean, certainly a UFO is a UFO, and look, it could create a turning point. But if that was to be the case, typically you would see price turning down, getting close to where the EMA is, and bounce from that and continue. So, it's not a big concern. We are not expecting a continuation of the move to the downside unless the climate changes color. Okay, and therefore, we are thinking that any moment in time you may see green UFO show up and that red UFO goes away. Okay, so not a problem, and no matter the time frame, the concept is the same. Okay, very good. Joe, UFO can go away. Keep checking options volume. Yes, exactly. Very good. Perfect. So we are all in sync. Okay, so let's first of all review the trades that we have. So first of all, we have a trade with G. This trade with G has an expiration date of April 29. Okay, so let me load GE. Okay, so here G, let me move to the right, exactly the right place. So this is the price range that we were expecting the stock to remain in between. So we are using the 98 call strikes and the 87 put strikes for this double calendar. Okay, if we look at the risk profile of this trade, this is the trade that we have running at this moment in time. So the net PNL of this trade is around $2 net per contract. So the trade is doing what basically is supposed to do. And on the next week, right? On the next week, that's when the earnings are supposed to take place. Let me see that. I am surprised at that. They have had a big change of earnings all the way to July. That's 3 months later. That makes no sense. Oh, here, yes. I'm not sure how I was looking at these guys. Sorry for that. Yeah. So April 26. I'm really not sure why I didn't see that little E in the bottom. So April 26, right? So April 26, which is happening next week, which is prior to April 29. Okay. So basically, what's very likely going to happen here, okay, and we can see that very quickly. Let's look at it in an option chain, for example. So if you look at current expiration date, which is April 22nd, and next expiration date, which is April 29. So if you look at the other money strike, for example, the 93, the current expiration date provides 35 IV for the calls, where the next expiration date, where the earnings are built in, is providing 50, right? So much more premium on the next expiration date. Why? Because of the earnings report. So again, what should we do with that? Well, what we should do is the same thing as always. We need to look and explore and see if those Greeks are distorted so we can roll to the next expiration date. But remember, for the next expiration date, since we are already using April 22nd, and the next expiration date is going to be April 29, so then we cannot use the same strike, because if you are long by the April 29 98 call and then you sell the April 29 98 call, so basically you are closing the 98 call. So we're going to have to go one strike above and one strike below. Okay, so we're gonna have to explore that. Yes, Mark, you are correct on that, and Joe as well. On let me bring in TOS. I also had the order for the 98 call waiting to get filled, and that 98 call at 15 cents is still there waiting to get filled. Good till cancel. Okay, the current mark is 1 cent, 1.5 cents. So I mean, I would say, being tomorrow the expiration date, I would say it's no way we're gonna get filled on this one. Okay, so then we are just gonna basically we missed on 15 cents of premium, but while we missed on 15 cents of premium, You got filled at 14, Christian. Wow, you were watching this very closely. Good job. Good job there. Very, very good job. So we missed on 15 cents of premium. And while obviously, it's not the best outcome, in the end, remember the beauty. Not sure if beauty is the right word in this case, but you get my point. The beauty is that we didn't pay commissions to get in, we didn't pay commissions to get out from the expiration date from the last week, and also we didn't leave any premium on the table from the prior week expiration date for the call, isn't it? So with all of this combined, well, you did not miss on 15 cents. I mean, you did miss on 15 cents, but at the same time, it's not that big as a deal because you did optimize to the maximum the prior week expiration. So this will happen sometimes when the range is very wide, when volatilities shrink to a certain level. If the stock moved a lot away from the midpoint of the range where you started, so there may be that one side of the double calendar cannot get filled and you cannot roll. Okay, so that's why we do the way we do it, and sometimes this is to be expected. Actually, in my case, it also happened with AMD, as you can see, where I did not get filled on the 124 call at 15 cents. Okay, so again, not ideal, but not a big deal. We're talking about a close to $100 stock, 124 in this case, and we've missed on 15 cents. So not the end of the world. Okay, so let's go for it. Let's go ahead and simulate what would happen if we were to do the roll. Okay, so I'm going to copy primary spread. Now, of course, to do the roll, you need to have distorted Greeks. So let's take a look at the Greeks. I'm pretty sure they are, but let's go ahead and take a look. So we're dealing with the 87 put and 98 call. Well, the 98 call, there's nothing to roll because we don't have it. Okay, so we're going to sell the 99 call. I'll do that in a moment. Let's start with the 87 put. Okay, so the 87 put, let's see what's happening with the 87 put. So 87 put, let me go ahead and highlight one strike. We'll highlight the 87 only. Okay, so the 87 put is showing a theta value of 5 cents. The expression is tomorrow, so 5 cents times 1 is 5 cents. The bid and ask is 1 to 2 cents. So notice how theta suggests more premium to be made than the premium available, which is nonsense, and therefore the Greeks are distorted. So we are going to be focusing on the next one, okay? But again, the next one won't be the 87. It's going to have to be the 86, okay? So let's do that. Okay, let's do that. We're going to be doing the 86 that expires on April 29. So we got 87.86 instead of 87.87. Okay. How much is that one going to pay me? So we'll see that in a moment. Okay, and then for the 98 call, we did not get filled on the 15 cents. So the reality is that those 94 cents I got there, okay, those 94 cents I got there should be diminished by 15 cents. So that's 79, okay, because I did not get filled. So it's 79. And what I'm going to do here is take April 29, and instead of selling the 98, I'm going to sell the 99. Okay, and I'm going to have to add to this value whatever I get paid for the 99, and I'm going to have to add to this value whatever I get paid for the 86. Okay, so let's do it. Okay, let's do it. And I will input those values in a moment, and we will have our new risk graph. That will be the last one to observe because next week, that's when the trade concludes. Okay, so let's go ahead and I'm not sure why I went there. GE. Let's go ahead and start with the 87 put where we are short. Right click and roll it. Okay, so we're gonna roll it from 22 to 29, but instead of 87.87, we're gonna do 87.86. Okay, if we do that, we're supposed to get 61 cents of credit. So let's see how much we get. I'm just going to place the order and wait until I get filled. And if not, I'm just going to push it so we get filled quickly. And then the other one with GE, which is the 98 call, okay, that expired on the 22nd. Remember, I said I want to sell the 99 call that expires on the 29th. So I'm going to right click, cancel, replace the order. If there is any condition, which should not be there anymore. Okay, it's all empty, right? Because that condition was met on Monday. So there is no more condition. So I'm just going to go ahead and change date, change the strike, okay, and remove any limit price. Okay, I just got filled at 61 cents. It seems that we may be able to collect 55 cents. Okay, so doesn't need to be good till cancel. I want to do it right now. Okay, so basically I am now canceling my order and I just got filled at 55 cents. Okay, so great. So I just got my call and my put filled. So now it's time to get those values and input that in the simulation. Okay, so I paid 2 cents to get out. I collected 63 cents. That's 61 cents net on the put side. So let's go back here. And therefore, to this put, we're going to add 61 cents. So if I bring in the calculator, so 156 plus 61 cents, that is 217. So that would be the net total credit collected. Okay, and then on the call side, I've got 58 cents for the call. So 58 cents means that I'm going to take my 0.79 and I'm going to add 58 cents to that, which is 137. Okay, so this is the trade that we have. Okay, and notice that this trade is a bit less beneficial than what I would have liked. And the reason why I say that is because now this is the risk profile that you see with the final expiration date, which is April 29. Actually, no, we don't see that. Yeah, what we see here, yeah, notice if I put my mouse here, it shows April 22nd. Okay, April 22nd. Okay, we can see that. But let me do the math here. So yeah, actually, it's fine. So notice that if we didn't do what we just did, the risk of this trade was $150. Okay, so worst case we're gonna lose $150 by doing what we just did. So now worst case of this trade is to lose $46. That's the worst case. Okay. The best case of the trade, if we hold it all the way to the expiration next Friday, when the market closes on Friday, it's going to make 54. That's where a little bit of the disappointment comes in my place. Typically, I guess that the implied volatility for that stock didn't rise as much as expected. We're going to look at the chart of implied volatility in a moment, but I would have expected this bottom line to be a bit higher and many times above the zero line. So where you have a very tiny loss in comparison with the amount of profit you're going to make. And that makes for the trade to be way more quality. Obviously, we cannot change that. The levels of premiums that are available are where they are. Okay. So anyway, something to observe is what's going to happen in the following days, because if let's say now it's Monday or even tomorrow Friday, Monday, Tuesday, before the earnings, we may have a rise in implied volatility. Okay, and if that's the case, okay, so we may see the profitability to go higher. So far we are with a minus $13 P&L, net P&L, after doing all the rolls. Okay, so if implied volatility rises, that line may go above the zero line. So this is something for you to watch and apply, let's say, common sense. Of course, you want to have a set of rules in your trading plan beyond common sense, but common sense would dictate that, if you go above the zero line and the amount of profit you have as we are approaching earnings happens to be very close to the maximum profit, which is 54, well, then it's worth it to just close the trade and remove the risk and you're done. Okay. Why? Because, out of earnings, you may have, a major gap up or down and the stock is trading somewhere here. And then you have a correction or a lot of profit taking and the stock then comes back somewhere in the middle on Friday. And next thing you know, while you were sometime during the week in a nicely profitable situation, then on Friday, because of profit taking, you are back towards, 90 something. And next thing you know, you ended up with a $46 of loss instead of 50 plus or close to $50 of profit. So again, use common sense for that. Typically, earnings reports will generate a move. So if that move puts you in a profitable position and you are close to the maximum P&L, just close the trade. Okay. you may have a little bit of a challenge of closing some units, because if price has gapped and moved a lot, some of those units may become illiquid because the strike price is far away. So then you may need to be patient on trying to get filled, or just leave a limit order and just wait until you get filled before Friday next week. But at least on the profitable side of the equation, the call side if the gap is up, the put side if the gap is down, just make sure you realize those profits if those profits are available out after the earnings report. Because again, very often you would have that kind of an effect. You got a gap up or gap down, so now you are maybe somewhere in here when it comes to the P&L, right? So close it. And if you cannot close the other side, in this case the put side, is not a big deal. Just close the call side, get some of those profits, and then if there is profit taking and the stock goes back somewhere here, now you can close the put side for less of a pain. With the two together, may bring you to even above the maximum P&L of 54, because basically you are timing the exit, right? But again, you need to be a little bit of on top of that, which in a case like this is important, because this trade has risk. $46 of risk, which is nothing compared to the original risk we started with, but there is risk, and therefore it would be less efficient to just close your eyes and leave it alone. Okay, so just watch it and act on it the way I just described. Okay, that would be the way I would approach it, the way it's done. So anyway, let me float this chart out. Let me grab these copy options to the clipboard so I can put that in my positions panel. Okay, and this trade is almost over. We have 1 week to go, and next week we will discuss the final result of this trade. Okay, you guys will tell me, but it's not looking too bad. It's just that in many other cases you have a little bit of a greater rise in implied volatility, and that makes up for a better outcome, as well as if we had collected those 15 cents of credit like Christian did. So next thing you know, you would have, instead of $46 of risk, you would have 46 minus 15. So that's, again, a better position. Okay. So, yeah, so that's all. Jeff, what happened to sell the call? Well, I just did it, right? So what I did is I took my call order that was up here. Okay. This call corresponds to AMD. Okay. So it's not there anymore. It's not the one we're talking about. But a moment ago, I had a call order for GE. And what I did is I right-clicked, I replaced it. And instead of using April 22nd, 98 call, I replaced it to be April 29, 99 call, and I got filled at 58 cents. Okay, that's what I've done. So that's what happened to the 98 call, which had been replaced. By the way, in your case, Christian, you would do the same, but instead of just selling a call, what you would do is just a roll. You would roll the call to go from 98 call in April 22nd to 99 call in April 29. I believe this is clear for you, Christian, but just saying it just in case. Very good. Perfect. Okay, so this is G. Okay, and then if that's okay, I'm just going to move to the next one, which is HOG, Harley Davidson. And here, to be honest, with so many activities and so on, I am not fully sure of what I've done, but the fact is that HOG is not in my account anymore, which I believe means that I closed it. And you guys probably remember better than me, and I'm sorry to not to remember properly, to be honest. I just noticed this as I was looking at the screen. I may have closed it last week. I remember we talked about multiple scenarios on this trade, because with HOG, if I recall correctly, they changed the earnings date, right? And the earnings date was extended by 1 week. So I think I said, yeah, I'm just gonna close it. I believe that was the case. Because everything would have expired on April 22nd, and I think it was, it was not an advantage. So I think I closed it all. You guys please correct me if I'm wrong. But the fact is that I don't have this trade in the TOS account anymore, so I believe that's what I've done. But again, if you have any question on that one, let me know, because I guess that your question may help me to remember, and then I can give you more guidance if your trade management was different than mine. But in my case, I think that I just got rid of it. Because that change of earnings date, created a situation where whatever you did was not that advantageous. So I just got rid of it. I think that was the case. So I'm going to look at AMD, unless you guys Yeah, Christian, you're out too. Very good. So if there is any question, or what I just said is not accurate because I don't remember correctly, let me know, and I'll go back to it, and I'll give you answers if you have any question. The next one is AMD. Okay, which AMD, if we look at the chart, it's a little bit in the bottom part of the range, and that's what I meant. So when you are far from the upper part of the range, which is the case, it's difficult to get filled on the call side. Okay, and that's why here with AMD, just like what happened with GE, I have an order to sell the 124 call that expires on April 22nd at 15 cents, and we never got filled. Okay, so yeah, we're gonna have to treat it the same way as a GE, very similar, because also the final date for this trade is April 29. Earnings are happening on May 3. So we have another case of a stock that has changed the earnings date. That is always disadvantageous. I remember sharing with you that around 40% of the cases, it's going to be, is my statistic, rounding numbers of times I see this happen. So it doesn't happen that often, but it happens fairly often. So when this happens, don't be that surprised. It does happen. Okay. And therefore, let's see if we can mitigate the problem by doing our rolls and tweaks, and see how much improvement we can bring into to this particular trade. Okay, Mark, you still have two HOG 35 puts. Okay, so you keeping them because you've been monitoring this trade, and basically you saw that price going higher, you have UFOs, and in your mind price is not going to get there before tomorrow or next week, tomorrow actually, right, with HOG, and you're just leaving them there to expire. Is that what you're doing, Mark? If you're doing that, I mean, I wouldn't say that it doesn't make sense. I think that's a fair approach to managing the trade, given the fact that the stock has moved higher by a lot. At the same time, make sure that there is no hope in the equation, and in case the stock was to start falling hard, you are prepared, you have exit orders or whatever your plan is, but let's not you try to sell at 15 cents, you try to sell or try to buy back. Oh, you have the 235 puts long, not short. Got you. So you're just leaving them alone, waiting for them to expire. Okay, I got you. I got you. Could you sell something against if this is the only thing you have? So we are talking about April 22nd, correct? With HOG. We are talking about April 22nd. Yes, correct. Okay, let's not make a mistake with that one. So, okay, so we're looking at April 22nd. You have the 35. Okay, no one is bidding. No one is bidding. Okay, yeah. So, yeah, sell to close. I got you. I got you. I got you. I got you. Okay. Yeah. So I'm thinking that if you cannot get filled to sell the 35, maybe what you can do is, um, how do we call it? Try to sell the 34 below, right? So you make it up to 20. Of course, there is no one bidding, so getting 20 is going to be very difficult. But maybe what you could do is, even if you sell it for 5 or 10 cents, that's gonna at least save you a little bit of money on the net outcome of the trade. So again, let me explain that to make sure I understood. So my assumption based on what you said is that you own 35 puts long. If that's the only thing you have long and you cannot get rid of it because you try to sell it but you're not getting filled, maybe try to sell the 34 put. Again, it's further down, it's more difficult to get filled, but you are also going to bid, you're also going to ask less. So the current people trying to sell are asking 20, So if you were to try to sell it for, let's say, 15 or 10, you may get filled. Let's say you get filled on 10 with patience, okay? And if that's the case, now you are leaving $10 less on the table. Is that making sense? So you could do that. Basically, you have a bearish spread, okay, a bear put spread here, which of course that would pay you nicely if the stock was to drop to 34 or below, which is very unlikely. But in this case, you are just doing it for a cost reduction point of view. You are selling the 34 put just to make the 35 put to be less expensive. Okay, so consider that move. You just got filled at 17. Okay, got it. So then that's it. So you're out of the trade. You had nothing else. So perfect. You got filled at 17 by selling the 34 or the 35 mark, just to make sure I understood. Okay, I'll wait for your text. Yeah. Anyway, going back to AMD. Okay, going back to AMD. So we are very low in the bottom part of the range. Expiration date is on the 29. They changed the earning days to be May 3. So ideally you would use May 6. Okay. But yeah, we are out, on the week before on April 29, right? So what can we do? Okay. So let's take a look at the option chain first of all. AMD. We're going to be looking at April 22nd, April 29. So we are dealing with the 124 strike and 103. Okay, so those are the strikes we're dealing with. Again, you can see how the 124 is trading at 1 cent, but even the next expiration date, the 124 is trading at 3, right? Very little implied volatility. So implied volatility is 84. If you look at the next expiration date where the earnings are, notice how the 124 call that has 15 cents is not like it's a lot, but it seems, well, actually, we are dealing with distorted Greeks here, okay? That's what's happening because it's so far out of the money. So it's telling us that, 15 cents on the next expiration date, it's only 75 implied volatility, where 3 cents on April 29 is 85, okay? And the problem is that, being so far out of the money, so those Greeks are quite distorted. So it's not a good example. But again, if we look at the put side, it should look better. So we got 63 on the next week, and we got 68 on the week after. So again, more implied volatility on the expiration date lining up with earnings as we normally see, okay? So that's the one we like to use, but that's going to be a tough one. So we're going to have to do an analysis similar to what we did last week. I'm going to try to be pragmatic because I would like to get into finding a bullish trade, because this exercise I'm about to do is basically copy-paste from the one I did last week for HOG. And therefore, if I could save a little bit of time doing it, I guess it would be more helpful that if I do the whole thing. So let me go ahead and analyze this trade. So first of all, what is the current risk on this trade? So the current risk on this trade per contract is 189. So what if I take, okay, the call side and I move it to April 29, okay, and I take this call side and the current premium collected, which is 71, I diminish it by 15 because we never got filled. So that would be 56. Okay, so 0.56. And then instead of 124, I make it 125. And then I take the put side, move it to April 29, and instead of 103, I make it 102. So what if I do that? Okay, so this is like the classical approach, even though the problem is that we are not going to get that much premium given the fact that, how do you call it? Given the fact that, the earnings have been moved by 1 week. Okay, sorry, I was having difficulty to phrase what I wanted to say. So anyway, let's roll that put. Okay, the 103 put, we're going to roll it. Notice, by the way, the 103 put, let me show you here. So the 103 put is in the money. Okay, the current value of that stock is it's 93. So we are $10 below 103. So that option is in the money by a lot. So when we roll it, the effect that we're gonna get is not that powerful compared to being close to at the money instead of so deep in the money. Okay. So anyway, so if we were to roll 103 to 102 from April 22nd to April 29, put this looks like it's gonna be a negative debit. I'm not happy to see this. Let me take a look. Option chain. So if I roll from April 22nd, right? So I buy this option at 1065 and then I sell that option at 1065. So basically I'm staying in the same place. So this is something I am not liking. The spreads are a little wide here and I'm not getting I will get just 5 cents of premium here if I do 1070, 1065. So that's very, very little premium for an extra week. This is really, really not something I'm happy to see. Let me see. Oh, sorry. I'm looking at the wrong strike, 102. Okay, so it's actually worse. Okay, so I need to pay 1065 and I get paid only 980. Okay, so I am not happy to do this move for obvious reasons because I am actually creating an issue instead of helping the trade. Okay, we saw these kind of things the other day with HOG, which is the effect of having an earnings day to be moved away from us. Okay, that's a problem because then it shrinks a lot of the premium. So the options you are long are losing money. The options you want to sell have less premium because the extra premium is now passed to the next expiration date. So that's a problem. Okay, so I'm really disliking that. Plus the fact that the 125 call only pays me 1 cent to 2 cents. This is really a situation that is not beneficial at all. So what's the P&L of this trade as we speak? The P&L of this trade as we speak, it's net 157. Okay, that's the P&L of the trade is net 157.5. We can see it here. Okay. So what can we do to try to help this trade better? That's the question. Okay. Can we do something to try to help this trade better? Because by doing the normal action, we are at a disadvantage here. Two things have happened which are problematic for the trade, which is number one, price moved far away from the midpoint of the range. Number two, the earnings have been moved to 1 week later. The two things combined are a problem. I mean, if you think about what was the original risk of the trade, so the original risk of the trade was, let's do the math. So the original risk of the trade was 239 plus 315 minus 46 minus 89. So the original risk of the trade was 419. We are currently losing 1.5 per contract. So, you could go ahead and close the trade. Obviously, it's not the best, of the happiest, way to conclude a trade, but it's part of trading. You take a loss and the loss is being reduced. So it's fine. Not a problem. Okay. But I'd like to explore if we can do something to have this trade a little better, because obviously exiting, with all those disadvantages on top of each other, it's a problem. Okay, so let's try to see if we can do something a bit better and help the trade further. So first of all, the limitation we have is the fact that we went deep below 103. Okay, so that's a limitation that we have. Okay, that is making everything on the call side to be very cheap. Okay, now very cheap also means price is very far from 124. Price is very unlikely going to get there. So what can we do there? Okay, knowing that we own the 124 call long. Okay, that one we own it already. We paid 239. Okay, and now it's trading at 2 to 3 cents. So closing it now, basically, it's basically kind of a guaranteeing that you take that as a loss. Which again, nothing wrong. Maybe the solution for this trade, if there is a solution, is to get rid of the call side or forget about it, okay, and then reposition ourselves with the put side and try to do something with the puts below and try to help the trade in a different way, okay? Which probably that's going to be the route I'm going to take, okay? So first, I want to look at what happened to the implied volatility. So since we started the trade, okay, the implied volatility has been rising overall. So that has worked in our favor. The problem is that right now, when the extra rise of volatility is going to happen, this has been passed to the May 6th. Okay, so really planning to do anything that takes care of a greater rise of volatility is something I cannot do unless I move to May 6th, which given everything that happened on this trade, I'm not going to do it because I know it's not going to work well. So what can we do here? Buy a put spread now. Well, we're going to do a ratio spread actually. Okay, we're going to do you'll see it in a moment. And with that, we will probably going to help the trade to go better. Okay, but again, my point here is trying to benefit more from a rising implied volatility, which is the original idea behind a double calendar, is something that we are not going to be able to do. So what I'm going to do is switch my mindset, and given the fact that the implied volatility already has been rising, and the expiration date that we're dealing with, which is April 29, will not rise more because the extra volatility will go to May 6 and we don't have any of that. So then what I'm going to bet is I'm going to bet on volatility to drop on that expiration date in the form of premium decaying. And therefore, I want to position myself as a theta trader here instead of positioning myself as a vega trader, which is what I am all the time during the life of this trade. I am collecting a little bit of theta, but I got way more vega, right? Well, in this case, what I want to do to convert this trade into something else to try to offset the problem is I want to convert it to something that becomes much more a trade that benefits much more from time passing and therefore much more sensitive to theta. How can I do that? Well, first, copy what we have. I'm going to get rid of the call. Okay, so I'm just going to leave the call alone, right? So the call I have here, the April 22nd, I'm just going to leave it alone, okay? I'm just going to remove it from here directly. So, I'm gonna assume it's going to expire out of the money and expire worthless. So those $78 I collected from the calls, actually 71 minus 15 because I did not get filled on the last week. So 71 minus 15, that's 56. So that number, I wanna subtract that value from 239, which is the original call I bought. Okay, and therefore I know now that the net cost of this call is 180.83, and by getting rid of the short call, if I click OK, basically, I got the same risk graph because it's the same thing. Okay, so of course the risk graph, even though it got higher, which is beautifully seen from a theoretical point of view, but I would say it's no way we're going to go there because the current price of the stock is right here. Okay, so we are very, very far from benefiting from this rise in profitability. Okay, so again, I'm just getting rid of that short call because I want to kind of like pretend that even though I have it, okay, let's pretend it's not there, because the reality is that if I want to close it, I want to get 2 cents for it, which is kind of saying that those $183 are lost no matter what. You could maybe recover 2 of those dollars, which is nothing. So I'm just going to leave it alone and pretend it's not there. Now, on the put side, that's where I want to work. I want to work around the put side and see if I can create some sort of an improvement. Remember, the improvement I'm looking for is always the same. Looking to reduce the risk while giving the trade a second chance. Okay? So how can I do that? Well, if you think of that 124 call and you think about forget about it, okay, which is what I just said. So I want you to be thinking that we have the 103 put. Okay? That's the 103 put that we have. The current price is way lower than that. The current risk that we have is 1.5. Okay, so 1.5, if I find a way to create some sort of a credit, right? If I find a way to create some sort of a credit, um, that minus the risk of 2 strikes away, that's $2 times 100, 200. So if I use, for example, the 101 put, which is 2 strikes below, that's $200 of risk. $200 of risk minus some credit is going to be 150 or less. Okay, I'm just estimating. We're going to see that in a moment. So I would like to think about it this way and therefore sell 2 of the 101 puts and then buy 1 of the 99 put and see what happens. So if I do that, and now everything would be April 29, the 103 put, I already have it one April 129, everything else is to be built. So you guys tell me, anyone knows the name of the strategy if I do that? Right? I have 1 put above, I sell 2 puts below, and I buy another put below, all equal distance. So what's the name of that strategy? I'll take a sip of water and you guys tell me. And by the way, I said a put ratio spread because this is a put ratio. Okay, now if I take a put ratio and I add this put above, so the whole name for the whole strategy is what? It's an iron butterfly. Sorry, it's a put butterfly. It's not iron. It's not combining calls and puts. It's all put. It's a put butterfly. A put butterfly where its risk profile is exactly the same as an iron butterfly. So my intention is to give the chance, to give the trade a second chance, okay, while I collect more premium and therefore potentially reduce the risk while I give the trade a second chance. Okay, so again, always working with the same principles. Okay, very good. Thank you, guys. So let's see what happens. Okay, so if I add an options leg, which is buy the 22 103 put at the midpoint and sell 2 of the 101 and buy 1 of the 99. So let's see what we end up with. Okay, let's see what we end up with. Oh, sorry, I'm just realizing I made a mistake here with the expiration dates. This should be April 29, April 29, April 29. Here we go. Now, yes. Okay, here we go. So what do we have now? Okay, so first of all, also to simplify and not to make it too complicated on the screen. So if I buy back this put, I'm gonna pay 11.23. I'm gonna pay 11.23. The one we sold it at 294. Okay, 294. So if I do the math, 11.23 minus 294, and 11.93 minus 294 is 8.99. Okay, so 8.99 means that my just like what I did for the call, where I left the call by itself. Okay, so if I get rid of this April 22, okay, if I get rid of this one, okay, the cost of this put, okay, if I was to add this information to the equation, so that one is gonna cost me. It cost me net 899 plus 315, which is equivalent to 12.14. Right. So now notice that now everything is April 29. Okay. Now everything is April 29. I have a call there. Forget about it. And then I have 4 puts, which is the 103. Let me get rid of this one. So I have the 103, 2 of the 101, and the 99. Okay, so the put section here is my put butterfly, and then I have this lonely call, which is likely going to do absolutely nothing. But again, if I close it now, basically I'm just guaranteeing losing that. So what happens if I do this? If I click OK, Okay, so yeah, so not working well because we are actually adding risk. Uh, and again, the problem is coming from the fact that the problem is coming from the fact that again a lot of premium, a lot of implied volatility is going to the next week expiration date. Okay, so if I use puts below the 103, trying to get closer to the current price of the stock, is not helping much. So I'm gonna try to use puts which are on the other direction, because the other thing I could do is I could add strikes, but you will see that unless there is a lot of price anomaly, so my risk here would be 279. Okay, 279. So unless there is a lot of price anomaly in the equation, if I go 103, let's say 99, and let's say 95, right? So I got $4 of difference, $4 of difference. So if I duplicate the width, keep going down, so typically I would now have more risk. And you can see now the risk is 327. Right? So if I keep going down, and therefore I am widening the wings of this butterfly, I'm adding more risk. So what I could do is do the opposite, which is go in the money, which many times may not work too well. But again, sometimes you have price anomaly in certain strikes, and then it does end up helping. So if I do 103 and I go 2 strikes above, I do 105, and then I do 2 strikes above, I do 107. So 107, 105, 103. Okay? So it's the same thing, $2 strike price increments, but going up instead of going down. So if I click OK, let's see what's the result of this combination. And yeah, I end up more or less the same. So there is not so much price anomaly. There is not so much of a bias for premiums to be in one direction or another. So yeah, it's problematic. I cannot reduce the risk of the trade no matter what I do. So really the right decision with AMD in this particular case is to just go ahead and close the trade now. To me, would be a better decision than just stay in it, because if you stay in it, you are not helping that much more. Okay, so that would be my decision for this trade. Just get rid of it, and that's it. Okay. Let me have one last review just in case. Yeah, so we said, yeah, so if we do April 29, and we do, yes, we said one, yeah, correct, yeah. Okay, and just reviewing just to make sure, yes, forget about it. So yeah, so not happy with the outcome of what's possible. Quite disappointed, to be honest, to see that there is really not that much premium that could be helpful for this trade. And in the end, that's what it is, and therefore we're gonna have to act the way I just suggested. If you, again, you don't have to, but if you want to follow the same types of rules that I use when I trade, basically I would give up on this trade. And the one positive aspect of it is that we started with a risk of 400 plus, and this trade ended up with $150 of loss when we close it all together. So that's, to be honest, quite positive, even though obviously it's not ideal. So I'm just gonna place an order to close all of it. Okay, probably we get a better price if I do the put side separately. Here we go. Create closing order to sell this one, and then for the call, create a closing order limit of 2 cents. Okay. On the call side, I got filled immediately. On the put side, it may take a little longer. If any, I'll push it later, and that's it. Okay, well, lots of conversations here, guys. This is, to be honest, is very important. I always say it is so true. Christian, we need a live link, Jose, to watch the video again today. Yes, no problem. So let me get that. To be honest, is a great habit, I guess, that you guys ask me for it, so I can share that with you. doing that. Give me a moment. And anyway, I believe that I'm being optimistic here, but let's see if we can get one trade plan before the session is over. Well, Christian, and here's the link. Okay, I just posted the link. So, Christian, I get your point about to focus on collecting premiums versus watching the price action. It is indeed a valid way to manage this type of trades because, to be honest, this type of trade is not a trade where you are relying too much on the price action. You are relying on the increase of volatility getting into earnings. So the problem is that, of course, when they change the dates, then now you are totally dependent on the price action because you are not going to get the increase on the implied volatility on that expiration date. And that kills you in most cases. The other thing that happens is that overall, that's the other aspect that made it difficult in this trade for the trade to perform better is the fact that if you look at the VIX has been going down for a while. Okay, and we just got filled on the puts. So as the VIX has been going down for a while, so these also create this cascade effect on most of the stocks. So for a few weeks, the rolls that we have done were not too good, and that's together with the fact that the earnings date has changed, that killed the strategy. Okay, but I'm not too concerned about not focusing too much on price action in this kind of application because this kind of application is pretty low delta. It's much more sensitive on Vega, as I said. So I'm not, I'm not against a methodology where you kind of, don't care about price action at all. In that scenario, remember when we scanned for those trades, we were looking for neutral strength both on the daily and the weekly time frame as well. So again, all of the components of the trade, are there for you to not to have to care too much about price action. Okay. Also, in my way on how to manage this type of trades, I like to be quite passive, and that's how I'm bringing it to you. Certainly, I could understand that some of you may like to be more active, and you may be watching price action, and you may have additional rules on top of it, where when certain thresholds are hit, certain UFOs are traded through, which may indicate a strong movement in a particular direction, a climate change, things of that sort. You may act on the trade sooner, and that could provide some benefits to you, but at the same time, it could work against you as well. If then you have a fast move in one direction just to be counteracted by a fast move in the complete opposite direction, which also happens very soon. And now you acted too soon, and then we went against you, and you are now in a bad position where if you didn't act, you would be in a good position. So pros and cons. What matters is that you have a trade plan where you know exactly what you're supposed to do based on your rules. That's what matters the most, so you can be consistent and through time create consistency with this type of trades, right? Instead of acting based on what you think may happen, and it's kind of a little bit of a guess, and that could be more problematic than helpful. Okay, so again, lots of sense on what you said, Christian. Love it. Just make sure you have rules around it. You have back tested it, and it works for you the way you want it to work. Okay. Now let's find one trade, at least one, to go long. So what I'm going to do is look for cheap options. So mean less than 20. We're going to look for top positive CIV spread. We're going to look for stocks that are pointing up. We're going to look for a classical scan list I use all the time. We're going to be looking at earnings to be at least 30 days from now. We're going to be looking at climates to be confirmed up early near the EMA, weekly up and early. Okay, and again, this is so demanding that probably I got nothing. Okay, so now we're gonna move to what about sensible? What about not near the EMA? What about sensible? Sensible. Here we go. So we got Medtronic. So we got one. So let's take a look at this one. Okay, 2 out of 5. Premiums are low. implied volatility blue above the gray. All of this is good. Now, do we have UFOs on the 15-minute time frame? We do, but we are far from all UFOs. We are far from the EMA. So yeah, so I'm not delighted with this one. It's a bit aggressive to get in, being far away from the EMA. So I would like to explore a few more options. Let's see if I remove weekly, what do I get? Still only one. That's interesting. I'm looking at group rotation. Okay, so what if we look at midterm instead of long term? Nothing. Wow. So yeah, so that doesn't make me happy at all. So then if we can't find a trade the way I just did, then I would like to reverse it. What I would like to do is I would like to look at stocks falling where speed bumps are. I would like those stocks to be strong, and I would like the climate to be confirmed down, ideally to be late. So markets that have been falling for a while, none. So what if I uncheck auto climate? We have no markets that have been falling. I mean, the market has been going up, but no market has been falling. What about the CIV spread? Interesting. We have no market that belongs to a strong sector that is in a place. We have BK, but it does not belong to a strong sector because I just unchecked it. So I would certainly not be comfortable doing that. Okay, so well, guys, my friends, I think that you're gonna have to try again tomorrow. Again, the good news is that the market environment, it's indeed defining itself in a very healthy manner for nice moves to happen to the upside. I guess it's now time just to be patient for some of those stocks to maybe fall a bit more into the speed bumps of support, or some of those climates to define themselves a bit better. And I would not be surprised that tomorrow you have more elements in the list to plan on bullish trades. Also, obviously, when I use my list, typically I get much less symbols, right? If I get rid of this list and I don't filter it out of the list, we got more symbols. And some of those symbols, to be honest, they have liquid options. So you can certainly try that too if you desperately need to add stocks to your portfolio. But again, typically patience pays. So my recommendation would be to try again tomorrow, especially if you use a list of penny increment stocks like I prefer to do. Yeah, that's what I would do. Okay, but again, I'll show you one more time how I had it set up earlier, so you could replicate that into tomorrow. So CIV mean less than 20, cheap options. You are looking at CIV spread to be positive. Stocks that belong to a strong group. Okay, we have all of this. You can then look at the climate to be confirmed up and early. Okay, you still have many near the 9 EMA. You also have a bunch. Sorry, I forgot to check my. I was surprised so many. Okay, now I'm less surprised. Okay, so not near the EMA, but it's early. What about sensible? Okay, what about near the EMA and sensible? Do we have any? No. So the market has been moving up, and therefore nothing is too close to the EMA. But I guess that looking carefully and using a little bit of patience, if we have a little bit of retracement later in the day, you may get some of those. Okay. Yeah. So you have a few. Okay. Medtronic again, it's a good candidate. The only problem is that it's a bit too high, right? So if it was a bit lower, you could start planning on the trade. Okay. First Industrial is also the same. MKC also the same. MSM better. Okay, but also a bit of the same. So yeah, I guess that tomorrow is going to be the day where you are likely going to have more opportunities, a longer list of opportunities, and therefore more stocks coming closer to the EMA, approaching UFOs. MSM could be one of those, or if you're using penny increment options, then you would add that filter too. Okay, but just scan the way I just did, and then you would be able to put your methodologies in place. Okay. Also, when it comes to putting the options trade together, just because it's been a while and some of you are new, we have not done directional trades for a while. At least it did not coincide with the sessions I did. So you can use the speed bump to project your targets, okay? And then you can come in here and right click where the target is and just send these to the strategy builder. So you can have your directional options trade build, pretty easily, okay? So you could certainly do that and go that way, okay? So scan the way I just demonstrated, set your targets, set your entries, and then right click to simulate your trades and build your strategies, and then execute, whichever matches your trading plans. So hopefully this works as a little bit of a summary of the steps to follow as we are concluding the session. Joe, yes, indeed, more top sessions on the Sundays. Okay, each month is different. Sometimes we do 2 per month, sometimes we do 3 per month. I believe in these months of April, it's been only 1, which is probably the reason why you made that comment. But yeah, everything is normal. So you'll see more sessions in the calendar, happening on the Sundays. Okay, in May we'll have the regular amount. Very good, everybody. Thank you for joining me. See you in the next one. I believe that's going to be next week on Thursday, I believe. So keep up the good work, and any question, either post it on the questions page or shoot an email. Happy to help. Keep up the good work. Thank you for joining me today, and see you on the next one. Bye-bye. Ciao.